Welcome to your Institutional Digital Asset Strategy Briefing for August 23, 2026. Today we're completely skipping the retail noise and diving straight into the underlying structural forces that are rewiring the market right now. Get ready because what's happening behind the scenes is absolutely fascinating.
Here is our roadmap for the briefing. We'll start with macro environment roots, move into capital health and market structure, check out narrative sectors and capital, filter through institutional insight and regulation, map out specific response scenarios, and wrap up with our final verdict.
Part 1, Macro Environment Roots. So what is actually driving this massive structural shift we're seeing? It really comes down to a staggering $4 billion move by the U.S. Treasury. Here is the setup. After a pretty catastrophic jobs report where we saw a huge miss, just 57,000 jobs added, the Treasury stepped in and aggressively doubled its long-dated bond buybacks to $4 billion per operation.
Gautam Shagani, a strategist over at Bernstein, really hit the nail on the head when he noted that the recent rally was driven directly from the longer end of the yield curve. Why does this matter to us? Well, by buying back these bonds, the Treasury essentially crushes long-term yields. Suddenly, parking cash in safe government debt doesn't look so appealing to asset managers. This literally forces institutional capital out on the risk curve, hunting for returns in assets like Bitcoin. This liquidity injection is the exact macro foundation sparking the current breakout.
Section 2, Capital Health and Market Structure. Now we need to look under the hood. That violent price push-up to $79,500, that wasn't just organic, everyday spot demand. It was rocket fuel from a massive short squeeze. Over $1 billion in leveraged short positions were completely wiped out in just a 24-hour window. This is one of the largest waves of forced institutional repositioning we've seen, which artificially accelerates the price upward and kind of masks what true demand actually looks like today. And right now, the derivatives market is flashing a massive warning sign. Hourly funding rates on exchanges like Kraken just hit an extreme 1.85%. To put that into perspective, the market is way too over-leveraged on the long side. This severe overhang drastically increases the odds of a sharp, sudden pullback simply to flush that excess leverage right out of the system. If that pullback actually happens, we have to look at the realized price as our ultimate safety net. Currently, that metric is sitting at roughly $52,000. It calculates the average price at which all Bitcoin last moved on-chain. If things get ugly and those extreme funding rates trigger a cascade of liquidations, that $52,000 level becomes our primary structural and psychological floor. Section 3, Narrative Sectors and Capital. We're actively seeing traditional asset correlations break down. Just look at this rotation. XRP just logged a massive 55.8% weekly gain, completely decoupling from the broader market. Why the sudden surge? Heavy hitters like Morgan Stanley and Goldman Sachs are aggressively acquiring trust fund shares. This targeted institutional capital flow is turning XRP into a total liquidity magnet, leaving typical retail correlations in the dust. We are also seeing a super clear divide between the leaders and the laggards right now. Ethereum is absorbing massive capital, with daily fees surging 5 times to over $1 million, alongside $219 million in ETF inflows. BNB is asserting dominance too, securing a massive 30.6% weight in Grayscale Smart Contract Fund. But then you have Solana struggling to keep pace. The core issue? A recent near-miss network outage that abruptly knocked nearly 29% of its staking offline. Fund managers are clearly penalizing that network stability risk. Section 4, Institutional Insight and Regulation. Okay, let's filter out the global regulatory noise. You might be hearing about the Senate delaying the Clarity Act until September. Honestly, just ignore it. It's pure political theater. The structural reality you actually need to focus on is the SEC's newly proposed Regulation Crypto Assets. This framework introduces a safe harbor rule that provides a very clear structural path for delisting decentralized tokens once central management steps away. That is a foundational shift for institutional compliance. But here is an immediate structural reality hitting today, August 23rd. Binance has permanently severed transactions with major platforms like HTX and EXMO to strictly enforce EU, UK, and US sanctions. This isn't standard business shuffling, it is hardcore enforcement. If institutional capital is routing through any of these entities, it is at immediate risk of compliance blocks. Section 5, Specific Response Scenarios. So based on today's data, how should fund managers react? We have 2 binary conditions. Scenario A is our bullish case. If that Treasury liquidity holds up and spot ETF inflows keep outpacing the creation of new leverage, it's a clear signal to overweight Bitcoin and XRP and increase duration exposure. Scenario B is the bearish trigger. If those extreme 1.85% funding rates spark cascading liquidations, you immediately hedge long positions and brace for a hard reversion back down to that $52,000 realized price. Now, what is the biggest black swan threat hanging over the market? Actually, it's not the macro picture at all. It's the plumbing. That Binance compliance crackdown we just discussed could easily create a sudden, systemic liquidity bottleneck across secondary exchanges. If counterparty panic spreads through those restricted platforms, global liquidity could seize up in an absolute instant. That's your tail risk.
Finally, Section 6, Final Verdict.
So where does that leave our risk-reward profile today? Our final grade is cautiously bullish on the macro front, but strictly bearish on short-term micro-leverage. That massive U.S. Treasury intervention fundamentally supports higher asset pricing for sure. But the derivatives market is running incredibly hot, and strict short-term risk management is non-negotiable until this leverage overhang is cleared. It all boils down to one absolutely crucial question for the next 24 hours. Will institutional ETF spot buy-in outpace the inevitable flush of retail leverage? Keep your eyes locked on the daily ETF flow data. Right now, it's the singular variable deciding our immediate market direction. Thanks for joining this explainer, and we'll see you next time.